Thank you everyone for joining today's webinar. I just want to let everyone know that today's presentation is available for download in the related content tool, and I will now turn it over to Jim.
Good morning, everybody. This is Jim Dascenzo. I am the National Director of the Manufacturing Solutions Group for HBK. I'd like to welcome everybody for our annual year-end tax planning for manufacturers. Although it is tax planning for manufacturers, we're going to cover a whole bunch of things that will apply across a number of industries, manufacturing, distribution, and others. Hard for me to believe that it is December already, but then as I sit here in Northeast Ohio and look outside at the snow and cold, it's a stark reality for sure. Hopefully what we're able to give you today is some updates on a number of things that have changed in the tax world, and to give you some planning ideas. And then also, I think interspersed throughout there, we'll talk about maybe some things that we might see changing going forward as a result of the recent elections and things that have been talked about over the course of the last couple of years. So certainly if anybody has any questions, submit them, and our contact information will be available at the end. So if you have anything and you want to send it directly to us, that's great too. We're glad to answer any questions you might have. So with that, I'm going to turn it over to Nick Demetrios. Thank you. Nick's a principal in our tax advisory group here at HBK and works directly with our manufacturing solutions group.
Thanks, Jim. And here's our bios. If anybody's interested in that, you can peruse that at your convenience. But we'll work through this. And from an agenda standpoint, the first part of the presentation, we're going to kind of go through some of the things that might be sunsetting under the Tax Cuts and Jobs Act, what's the current law, and what the proposals are under the incoming administration, and how that might affect the tax law going forward. We will cover some details on those different tax aspects. And then we will lead into some opportunities that we've talked about in the past, but that are still relevant for manufacturers as we go into the next year and this year, and things that we can still do to affect your taxes in 2024. Please go ahead and confirm your attendance and click the blue check at your convenience. All right, so under this first section, we're going to talk about the tax proposals of the incoming administration. Now, again, these are proposals. These are things that have been said during the election cycle or things that have been proposed by either the Trump administration or some members of Congress. And some of them are bipartisan, some of them are not. But we're going to talk about how they affect the current tax law as we stand right now. The corporate tax rate for C corporations is the present law right now is that it's a 21% flat rate. And unlike many of the provisions of the Tax Cuts and Jobs Act that was passed back in 2017, I can't believe that's already that old, it was permanent. Many of the provisions of the Tax Cuts and Jobs Act are sunsetting at the end of 2025. So we need to see tax legislation come into play to address those differences in the tax law, or else things will revert back to pre-2017 tax law, which could be taxpayer unfriendly in some situations, taxpayer friendly in others. But this is 21% flat rate we have is permanent, so it would take a legislative change to change it. But the policy proposal of the incoming administration is to keep that rate either at 20 or 21%. And there used to be in the tax law a DPAD deduction, domestic production activity deduction, that allowed you to deduct certain portions of your income on exports. And it was in play in the early 2000s. It went away. I think it went away after the Bush tax cuts. But Now we have 199A, but the policy proposal is that you may be able to exclude a certain amount of your domestic activity and lower your rate from 20% to 15% potentially for manufacturers. Again, this is for C corporations. So again, back during the Tax Cuts and Jobs Act passing, when the rate went down to 21% from 35%, we did a lot of C versus S, C versus partnership analysis to see if entity structure was the most efficient way we were set up to take advantage of the tax laws and the current qualified business income deduction under Section 199A. So I would venture to say that we would have a great amount of additional analysis if this does in fact pass to determine whether or not we are in the right entity structure and if it indeed warrants a change. Again, this isn't something that is prevalent to manufacturers so much, but if you are have investments via hedge funds or private equity firms invested in your business, there are certain carried interest rules that are in play where you can achieve capital gain interest on an allocation of income. Capital gain treatment on an allocation of income if you hold that interest for more than 3 years. This is something that would be sunsetting, so the policy proposal would be to extend the same rule. And again, this is just something I wanted to mention because this is an area of consternation amongst many people that this loophole exists. And they've tried to stretch it out instead of 1 year, make you have to hold the interest for 3 years to treat it as capital gains. And it's something that is still out there. It's a blip, really. It's not something that creates a lot of tax revenue, but or would create a lot of tax cuts. It's really critical for hedge funds and for private equity firms. But I just wanted to mention it here as it is sunsetting. Opportunity zone investments. This is something that was bipartisan and heavily used by many of our clients is investments in qualified opportunity zones, which were identified by state governors. And it doesn't necessarily mean that these zones were dilapidated areas. A lot of them were relatively nice, but they wanted to encourage capital investment into these areas. And if you invested a portion of a gain or a gain that you had within 180 days of recognizing it, you could defer paying tax on it all the way till 2026. And then if you held it for 10 years after, within 10 years, outside of 10 years from the date that you acquire it, any of that post 10-year appreciation is tax-free. So if you had a business that was in a qualified opportunity zone, you were looking at investing or putting a building in a qualified opportunity zone or starting a business in a qualified opportunity zone, this is something that is very attractive. This, again, the policy proposal would be to extend these rules, which would expire in 2025 under the Tax Cuts and Jobs Act. And continue that gain deferral possibility. It's very similar to a 1031 exchange or a like-kind exchange, whereas a 1031 is more permanent deferral. As long as you hold the properties, this isn't as much of a deferral, but it is something that is very flexible because you actually can hold the cash and invest. You actually have 180 days from the end of the year if you're getting a gain allocated to you from a pass-through entity from your K-1. So this is something that would be a nice extension.
There are funds out there that give investors the opportunity to partake in these qualified opportunity zones. We've seen a couple of our clients over the last couple of years defer some gains by utilizing the QOZ funds that are out there.
I see a question, and it's hard for me to read it.
Question is, to get the 15% rate, do you need to be a C Corp or can you be an S?
Yeah, I should have looked on the screen. It's easier to read there. You have to be a C. And that's why we would have some additional analysis to determine whether or not, if someone was an S corporation, does it make sense for them to be a C?
That's something that we've looked at. In years past, when the C Corp rate was 34%, and the individual rates were, that's something that we never really would have thought about, but it is, over the course of the last couple of years, something that's when the rates dropped to 21, something that we looked at more. And certainly if it drops to 15, it would merit even more scrutiny.
The thing that you got to think about is how much income are you going to take out of the business, be it dividends if you're a C corporation, because you will have double taxation. It's really a tax and cash flow analysis that we would do to determine if that's the best course of action. If you do switch to an S to a C from an S, you're stuck that way for 5 years. So it's not a decision to take lightly, but depending on the operation of the business and the goals of the ownership, it might be the best way to operate.
A lot of people think that C Corps are not a way to do business, but for certain businesses, even startups, C Corps can be beneficial by utilizing the lower rate to keep that capital in to grow the business. Like you said, you want to be really careful with a more mature company switching to a C Corp, and you end up selling. You're subject to the double taxation, so you got to be careful. It's not just based on current tax.
Yes. Yeah, it's an analysis, but it's definitely something that we would do a lot of if these rates continue to push down with those opportunities. The 1031 like-kind exchanges, right now the present law is that they're only allowed for real estate through 2025. This is a revenue raiser because it used to be allowed for like-kind equipment, other tangible property outside of real estate. The biggest one was like cars. You trade in your car for your business, and you get to defer any gain you may have on that. Right now, that's not the case. You basically have a taxable transaction when you trade in your car, and you end up with additional basis to depreciate. But the policy would be to extend the same rules, and we would be without like-kind exchanges on equipment and vehicles, just like we are right now. But like I said, it's not particularly friendly for manufacturers on the equipment and the vehicle side of things. But we've been operating under these rules since 2017, and that would most likely continue if they extended these rules. Qualified business income deduction under 199A. This is another thing that ties in very, very closely to the whole C versus S analysis. If you are a flow-through entity, you get a 20% deduction for qualifying income, and manufacturers are qualifying income. They're not what we call SFPBs or specified service trader businesses, medical, accounting, legal, those types of businesses. They're subject to their own types of limitations. And again, the policy proposal would be to extend this. Effectively, what this does is the top marginal tax rate for an individual is 37% right now. Because you get to take a 20% deduction based on some limitations for wages and property and things like that, you would be able to lower your effective tax rate to 29.6%. So again, if we're looking at a C versus S analysis, we're not comparing the C Corp rates to 37%. We're comparing the C Corp rate to 29.6%. So that rate arbitrage is not as great as it used to be. But again, if we go down to 15%, now we have a much larger rate arbitrage. And depending on whether or not you're going to take dividends out of a C corporation, it may make sense to operate in that fashion.
That would get even bigger if the top rate of 37% were to increase, go back to 39.6.
Correct.
Yeah.
Yeah. All right, limitation on business losses. This is a strange revenue raiser that it was in and out of the tax law over the past several years, and it got pushed out because of COVID under the CARES Act, and essentially the proposal would be to repeal this and get rid of these limitations. But what this says is if you are a flow-through entity, you are only able to deduct $578,000 or $289,000 per year. And those numbers, they seem odd because they're indexed for inflation. I believe they started out at 500 and 250. But you're not allowed to offset wages from your business with losses. You're not allowed to offset other income with these losses. They're really capped at these 578 and 289 numbers, and anything in excess of that would be an NOL essentially, and carry over for no limitation. Indefinitely it can carry over, but again, you could still end up in a situation where if you have wages that exceed this, you could pay tax in a year that your business has losses. And because you will see in later slides, we have depreciation and other accelerated deductions and things like that. This really isn't taxpayer friendly. So the proposal would be to repeal it, and it's something to watch on the planning side of things for right now because it is in the current law. And again, I should take a step back and mention that, the present law is going to be what we're probably dealing with for 2024 and maybe even 2025 by the time we get tax legislation passed. Usually when a new administration comes in, it becomes, there is a unified executive and congressional Congress right now going into the new year. But depending on what happens, we might not get tax legislation until the fall of 2025. Whether or not it's retroactive to the beginning of the year or not, we'll have to see. But keep in mind that we may be dealing with the present law for at least 2024, the remainder of 2024. So that's why these present law limitations are still critical to watch out for and what we can do to mitigate taxes for 2024. Bonus depreciation, we still have it. It's only at a 60% of tax basis clip for 2024. You can see how it will ratchet down under the present law for the next couple of years. And the policy proposal is to reinstate the 100% rate permanently or maybe just extend it. Again, bonus depreciation has been with us all the way back to 2001. I think that there was maybe 1 or 2 years that it was out of the tax code. So I am positive, I wouldn't say positive, but it's highly likely that we end up with some type of bonus depreciation in the tax law for the future. I don't know if it'll be 100%, but this is great for manufacturers, especially if the 461 limitations that we talked about on the previous slide get repealed, because you're able to recapture the CapEx expenditure immediately, and where you might have interest limitations or other things under some other code sections, this is very, very helpful in mitigating taxable income immediately for purchasing new equipment, used equipment, new buildings, all that type of stuff. Just to mention some international tax provisions, if you are a C corporation, you are able to take advantage of these next two provisions. Well, one's a carrot and one's a stick. This one is the carrot. Basically what this is saying is if you are going to sell or provide services into foreign markets, produce them domestically, but provide them into foreign markets, you can take a Section 250 deduction against that income And instead of paying a rate of 21% on it, that's the current rate, the way that you're able to deduct against that income, the foreign-derived intangible income, the FDI&I income, it lowers your rate to 13.125%. So again, it gives you an effective tax rate cut of almost 8%. After the 2025 year, that deduction decreases and your effective rate sits at 16.4%. So what they're trying to do is extend that rate out. And this is something that if you have foreign activity, we mentioned this in our planning slides too. If you have foreign activity, there's a lot of different things that we can do and look at that could potentially lower your taxes via an interest charge DISC, the FDI&I deductions. We can also talk about the global intangible low taxed income, which is on the next slide, or using C Corp blockers to take advantage of many of these deductions. So if you have foreign activity or sell into foreign markets, we should be talking about these types of advantages.
Nick, before you move on, I'm sure others may have this question.
Sure.
How does that apply to S Corps? So we talked about there how FDII gets a beneficial tax rate for C Corps. What about S Corps that sell into?
Well, S Corps have their own types of benefits that they can take advantage of, but a lot of times this works into the C versus S analysis, right? Because if you are an S corporation, but you have a high degree of foreign activity, you could be taking advantage of the FDI&I deductions, or you might be getting bit by the global intangible low taxed income, and it might make sense to operate as a C corp or have a different corporation set up. We've had clients that have actually set up a C corporation to run their foreign activity through, so they can take advantage of the FDI&I.
The other you're referring to is a C corp
blocker. Yes. The other thing that you could end up doing with an S corporation is an interest charge DISC, which we'll talk about later on in the presentation. But that's a good point, Jim. Moving on to the stick or the punishment of doing business overseas is GILTI, it's called, and that's an unfortunate acronym, but that's what they came up with. And this is under Section 951A, and the present law is in place for this applies to any entity that having to pick up the income. It's an anti-deferral provision. So if I'm a C corporation or an S corporation, or if I have a German GmbH company over in Europe that's doing foreign business, under the old tax laws, pre-Tax Cuts and Jobs Act, you were faced with paying tax when you repatriate money, meaning you would pay a dividend back into the United States. So you can control when you have taxable income. Under the Tax Cuts and Jobs Act, GILTI was put in place where and basically what it's saying is if I'm putting high value IP offshore, and I'm paying fees out of the United States to rent or lease that IP or to pay for that IP, I'm going to be faced with having to pick up a portion of that income currently. And there's a test where you have to look at the income that's generated over 10% of the fixed asset basis that's in the business. But in any event, we as a C corporation can take a tax deduction under that same code section 250 and lower the rate. That rate will increase from 10.5% to 13%, and the policy proposal would be to extend the rate to 10.5% to limit the damage this might pick up. Again, these are complicated tax laws, and there's other elections that can be made if you are a flow-through entity to try to mitigate some of this. But I would just rather this beyond the scope of what we're talking about here. But if you have these situations where you are doing business overseas, we should be talking about how these things are both disclosed and picked up for income tax purposes under your current tax structures. Okay, now a couple of individual provisions. I think I'm doing good on time.
Yeah, you got time.
Okay. So the individual income tax rate would revert back to 39.6% after 2025 if no tax legislation was passed. The policy proposal is to extend that 37% rate or make it permanent, and this is the only time that we'll talk about tariffs on this presentation, because they're, again, not an income tax item and beyond the scope of this presentation. But there's been some proposals or some discussions of, well, maybe we will really lower the federal income tax for individuals or get rid of the federal income tax for individuals and replace it by increasing tariffs. There's one article I read from BDO was talking about the individual income tax revenue being somewhere around $2.2 trillion annually, and tariff replacement could increase that all the way up to $4 trillion. But again, tariffs are paid by the people that are buying the goods, so that can both hurt and harm domestic businesses. So I'm not sure how that's all going to play out, but the policy proposal is, at the very least, to extend the 37% rate, which would be good. And again, that 37% rate on qualified manufacturing income under the 199A deduction drops all the way to 29.6%. So individuals are getting a nice haircut on their tax rates, even if they don't operate as a C corporation. Capital gains rates, I have them summarized right there. The long-term rates are 0, 15, and 20%, depending on what tax brackets you're in. And there's the qualified small business exclusions, where if you sell C corporation stock and you qualify as a small business, you could potentially exclude up to 100% of the gain, depending on how big the gain is. All of these expire after 2025 and could go back to ordinary rates. The policy proposal is to lock in a 15% capital gains rate, get rid of the 20%. They'll have the qualified small business options there, and also I thought this was interesting, index asset purchase prices for inflation, which could lower your gains. That would be an interesting calculation that we would have to track. But again, if you're looking at selling your business, these rates are extraordinarily important. It's also extraordinarily important as to what type of entity you are. So again, all of this stuff can't be looked at mutually exclusive from one another. We have to really take into consideration 199A. We have to take into consideration C versus S. We have to take into consideration long-term capital gains, small business stock deductions. To take all of that into consideration, and if you're looking at selling your business or acquiring a business for that matter, as far as what type of asset step-ups and different things that you could be getting. So it's critical that we look at all of these things interconnected.
Right, you can't just look at, and there's our first second attendance check.
Yeah.
So, but you're right, you can't. It's not as simple as just looking at the rate. Hey, the top individual rate's 37%. The top C corp rate's 21%. We should be a C corp. There's so many things that go into it, but it is something that does merit more consideration than maybe it did in the past. So.
Yeah. So especially if things, if these rates keep ratcheting down, we've always said for the past several years, well, we're paying historically low tax rates, so it's not a bad idea sometimes to actually just pay tax. That may still be the case. Social Security, I just wanted to mention this here again, not something that's mutually exclusive to manufacturers, but right now up to 85% of that can be taxed if you have combined income over $44,000 on an individual. This would, the policy proposal is to exempt all Social Security from income taxes like it used to be, what was that, pre-1986?
For my time.
Yeah, okay. Yeah, it's been a long time since any Social Security was fully exempted from income taxes. But, you know, in most cases, if you're just on Social Security, you're not paying tax on any Social Security. So, but if you are an individual that's collecting Social Security and you have other earnings and other income, your Social Security could be taxed. So this would be a tax cut for individuals that are picking up some of that Social Security in their taxable income. Tip income and overtime pay, again, right now all of that's subject to tax and employment tax. The policy proposal is to eliminate income tax on and increase the take-home pay of employees to exempt that from employment taxes or income taxes. We'll see how that comes to fruition. That could be, you know, manufacturers that pay overtime on hourly employees or unsalaried employees would be having to adhere to these laws. And again, it'd be a major change for how things are working right now.
Absolutely.
The SALT deduction, this is a big one, especially for people that are living in high income tax states like New York, California, a lot of the New Jersey, those areas where you're paying a lot of income taxes. Right now, you can only deduct $10,000 of real estate taxes, income taxes, any of those taxes. That's your combined deduction right now. And this would be for personal, individual Schedule A itemized deduction. The policy proposal would be to actually eliminate this limitation. But what we've done over the past couple of years and what most of the states have done over the past couple of years, I believe it's up to like 29 states or 39 states, all have these pass-through entity tax programs that really allow you to pay tax at the entity level and still get credits at the individual level. If this limitation changes, we would have to reassess how we pay non-resident withholding or pass-through entity tax for entities that have multi-state operations. So again, just another wrinkle to add to the analysis of things moving forward. I just wanted to mention too the estate, gift, and GST limitations. Right now, the exemption sits at $13.61 million with a rate of 40%. That can go down all the way to $7 million, barring any new legislation, which would be a significant increase in individuals that would be subject to the estate tax. The proposal is to extend the index for inflation limits, so you'd be sitting at around $14 million, and make permanent the 40% rate. Again, all of our estate planning people are very busy right now, especially because of these potential drops to $7 million. You want to make sure that your estate plans are being reviewed and are fluid for any potential changes that may need to take place in them based on what happens with this tax rules.
Right, and I can't stress that enough. The estate tax is something that is going to take up a lot of our time over the next year, and also a lot of the attorney's time. So better to get started on that sooner rather than later. So I highly encourage anybody and everybody to think about that and contact us sooner rather than later to get that process moving along.
Yeah, absolutely. And then there's some additional tax provisions that have been mentioned. Deductions for auto loan interest payments. If you're a business, you can obviously deduct any interest against the 163J limit, which is down here on this slide as well, which I'll talk about in a moment. But for individuals, that might be an additional itemized deduction. 174. That's the big thing that we talked about last year, and we'll mention later on in the presentation as well. research and development expenses all used to be fully deductible. Now they need to be amortized. There is bipartisan support to change that rule back to pre-Tax Cuts and Jobs Act, where you get to immediately expense those. It's important for both the software industry and manufacturing industries that they get to fully expense those and not have to worry about the add backs for amortization over 5 or 15 years, depending on where that research is done, domestically or foreign. So that's one that's been mentioned as being restored. Additional 179 expenses. Again, we're sitting at $1.2 million for 2024, 2025. There's been proposals to increase that even more. It's crazy. When I first started, the Section 179 limitation was $25,000.
It's $10,000 not long before.
Yeah, and now it's all the way up to $1.25 million. So they're talking about increasing that as well. So also expanded child tax credits. We're talked about by both the Democrats and Republicans. Those things are on the docket. And 163J is another big one. The 163J limitation affects a lot of businesses in being able to deduct their interest expense to 30% of their what's called adjusted taxable income. That adjusted taxable income used to be EBITDA, where we would be able to add back depreciation and amortization and gross up our adjusted taxable income more to deduct more interest. And what has happened since 2022, there no longer is an add back for deductions, for depreciation deductions or amortization deductions, and many businesses have been unable to deduct large portions of their interest expense and have been put in taxable income situations. Via 174 and 163J, we have seen some nasty tax liabilities rear their heads on companies that would otherwise have losses. So these two are very important and, again, have bipartisan support to get changed. So hopefully those things are on the agenda to be quickly adjusted in any sort of tax legislation. So with that being said, I'm going to turn this back over to Jim, and we're going to talk about some tax planning options, and we will continue to roll through these slides.
Thanks, Nick. It's always tough to follow Nick. I'm reminded of when I'm in this position. A couple years ago, I had to speak at a client's anniversary celebration, and the marketing director had me follow the congressman and then Jim Tressel. So I told him, I said, you don't ever follow Jim Tressel because you can't look good. And the same thing at a tax presentation. Following Nick Demetrios is a tough act, but I'm going to try and move through this. Some of the stuff that I'm going to flip through here, Nick touched on, and some of it, in the interest of time, we'll probably just pass over. But as far as tax planning options, it's obviously always easier to plan before the end of the year rather than after the end of the year. Something that is very big for manufacturers, distributors, and a number of companies that hadn't been available in prior years is the cash method of accounting. Cash method of accounting is, as it sounds, it allows you to recognize income when you receive the cash, to recognize expenses when you actually make the payment, rather than the accrual basis where you recognize sales when the sales are made and expenses when they're incurred. As long as companies have under $30 million or less of average 3-year average gross receipts in 2024, this method is available to them, and it is really helpful because you could, as I mentioned, when you pay the expenses, you could take the deduction, so you could use that as a way to reduce your taxable income. So it's something that we've implemented a lot. The cash method of accounting was always available, but it was very limited as to the people who could, to the companies that could utilize it. It's been expanded much more, and it's something that we are always looking at as a way to reduce taxable income and defer. I tell people all the time, if you're making money, you're going to pay tax. It's just a matter of when. So the biggest tool in our toolbox has been for years, has always been, and probably will always be, is a way to defer that income. It's always better to pay tax down the road rather than now, typically. So cash method of accounting is a great tool for manufacturers, distributors, all types of companies that have three-year average gross receipts of $30 million or less. There you go. Other options, this is something that we've done too, accelerating deductions into the current year. Bad debts, if you have bad debts, the write-off, taking the write-off in the current year rather than holding off, hoping to collect on that. Bonuses can be paid to non-related parties, can be paid 2.5 months after the end of the year if you're on the accrual basis. So you could accrue bonuses to employees and pay them within 2.5 months and take the deduction in the prior year. Or if they are related parties, meaning an owner, or if you are on the cash basis, paying those bonuses in the current year before the end of the year. So that's something that you would want to do prior to the end of December. Utilizing suspended passive losses, maybe trying to generate some passive income that you could offset those passive losses against. Prepayment of taxes and other items. There are also elections that can be made to deduct prepaid expenses in the current year. That's something that we do with a lot of our clients. Prepaid insurance, other types of expenses.
Real service contracts is another one. So like if you have software maintenance contracts or janitorial services, maintenance on equipment, things like that you could prepay, and it's something that's rateable where it's the same amount per month, we could deduct that too.
Yeah, and that's something to look at too. Trying to move through here. Oh, this side. There you go. I'm having a little trouble. Big one here. I have about 4 or 5 things that I talk to all manufacturers about, and near the top of the list is the R&D tax credit. So I'm going to spend a few minutes on that, and it's going to tie into something that Nick mentioned earlier. The R&D tax credit is a credit against tax. It's not a deduction. It is a credit, and it is a statutory credit. It is designed to increase research and development activities within the United States. So any manufacturers, any other businesses, so this really applies a lot to manufacturing and to software development. Manufacturers and other businesses that develop and design new products or develop and enhance processes to existing products or processes. So really, if you think, I think a lot of people, when they hear R&D, think, it's something in a lab that you're doing that's trying to create something new, and it's really not. It is a way of enhancing products, processes, existing products or processes. So qualified expenses are, they need to relate to the development of a product or a process, development or enhancement. They have to rely on the science, and they have to be experimental in nature. And you do not need to be successful in meeting that end goal. The example I always use is a pen. You have a company that's made a pen, the same pen, for 70 years. And if they look at new ways to make that pen better, to make the process of manufacturing that pen better, more efficient, whether they're successful or not, that qualifies. There's 2 types of credits that are available. You could take the alternative simplified credit or what's called a full credit. But that's something that's determined when you do the tax return. But qualifying for the R&D tax credit is something that we see. I'd be surprised if a manufacturer does not qualify for the R&D credit. There's certainly, and we'll get into it here in a couple of slides, where it's really beneficial now, even more beneficial than in the past. So, and this is the slide right here, is Section 174 amortization. Nick talked about it. Starting in 2022, as a result of the Tax Cuts and Jobs Act of 2017, something that was put in place there said, hey, starting in 2022, anybody who has Section 174 expenses has to amortize them and deduct them over a period of time rather than deducting them in the current year. We all went, I think the whole profession went for 5 years saying, oh, that's going to change. Then all of a sudden, 2022 was upon us, and it hadn't changed. And then 2023, and now 2024. So what we've had is people who have Section 174 expenses, which I'm going to define, we'll define in the next slide. We'll show you what they are. Companies that have Section 174 expenses had to capitalize them and amortize them over 5 years, so it was a big add back to taxable income. There has been talk for a number of years about eliminating these requirements, reversing them. In fact, in early 2024, the House overwhelmingly supported, I think to the tune of 357 to 70, passed a bill, sent it to the Senate, and the Senate decided not to vote on it. It just died in the Senate. There has been talk, based on the recent elections, that there could be something happening, most likely in early 2025, if it were to happen, or sometime in 2025, that may even make it retroactive back to 2024. So the best case scenario would be that those expenses would be able to be deducted in 2024, and any prior expenses that had been capitalized and were waiting to be amortized could also be deducted. That would be huge, because we saw a number of our manufacturing clients and other clients that had these big add backs and were paying tax that they otherwise wouldn't have been paying. So this would be a nice way to recoup some of that. And probably the most egregious example of how this affected companies, I've read an article about a software company that received a grant. If the grant was $1 million, they spent that grant on research and development expenses. So they had no money at the end of the year. They couldn't deduct those expenses. They could only deduct a percentage of them. So they ended up with taxable income and no cash to pay it. And that was the effect. That's the effect that 174 has had on companies. So this is something that we've been keeping an eye on for a number of years, or we continue to keep an eye on for some time. So I'm just looking at the time here, and so there's another attendance check. So if you want to check for your CPE purposes, and I'm just going to keep moving. So real quickly, what are Section 174 expenses? Well, your R&D credits, which are wages, computer rentals, contractor costs, supply costs, Section 41 costs are all part of 174, which includes a lot of other expenses. So your Section 41 costs that qualify for the R&D credit are a subset of the Section 174 costs that have to be amortized. So it makes it all that more important. You could have Section 174 costs and not be taking the R&D credit. That a lot of companies thought maybe a way out of having to amortize this is just to not take the R&D tax credit. That is not correct. You could still have, if you have Section 174 costs, you're required to capitalize them, and those Section 174 costs include R&D costs. So if you're capitalizing them, you should be taking the credit. Again, just moving through here to talk about some other items before we run out of time. Here's something, the work opportunity tax credit is something that I think it's overlooked often, and the reason it does is it just requires some additional administration that maybe companies don't have or won't spend the time on. And the work opportunity tax credit, again, it's a credit. It's a direct reduction of tax, and it's incentive for people in groups that have that qualify, that have historically had trouble getting employment, and it can be as much as $2,400 per year per employee, and then it actually is higher for veterans. So that's something to look at if you are hiring individuals of classes that might qualify. Certainly feel free to check with us on that if you think you might qualify. Energy investment credit. Again, this came in a couple of years ago as a result of the Inflation Reduction Act. It's a direct credit reduction of tax. Solar property, wind property, geothermal property. We've seen some clients get huge tax credits as a result of, as they're building new facilities by installing solar property, geothermal property. I don't think I've seen any wind property, but I'm sure they're out there.
The one thing to keep in mind is one of the proposals is that many of these Inflation Reduction Act provisions could be repealed as revenue raisers to pay for the other tax cuts,
right?
The Tax Cuts and Jobs Act. So when you have these projects in the pipeline, getting them in service in 2024 or 2025 would be critical.
Sure, good point. Nick talked about the deduction and limitation on the business interest expense, so we'll just skip right over that. We also talked about the excess business losses, so we'll move right through there. Thanks, Nick.
Sure.
He also talked about equipment purchase and bonus depreciation. Again, the bill that I mentioned earlier that passed in February of 2024 addressed three items specifically. It addressed reversing the Section 174. It addressed restoring bonus depreciation to 100%, and it addressed the 163J business interest expense limitation. Had that bill been passed and made into law, those would have all reverted back. So Nick mentioned that bonus depreciation now is 60% for, as we sit here today, it's 60% for 2024. So, as Nick mentioned, bonus depreciation was in place for a long time. So we had sort of not done away with, but we always chose to use bonus depreciation over Section 179 for a variety of reasons. And now we're looking at Section 179 because it gives you that 100% deduction. So again, that is something, one of the things that we often work with clients on is getting equipment into service, whether it's new cars, new trucks, new pieces of equipment prior to the end of the year to get that deduction. So now it's a balancing act between do we use bonus, do we use Section 179? So I see a question came in regarding the work opportunity tax credit. Actually, it's more of a statement, I guess, saying, yeah, and it's something I didn't mention. If companies, if you're using a third-party payroll service, Paychex or an ADP or any others, they likely have a service for a fee that can facilitate those obtaining those requirements to see whether somebody qualifies and you can get that credit. And it's definitely worthwhile to look into. So thank you for that. I keep hitting the wrong button. There's the bonus depreciation. Through 2022 is 100%. You see it phasing down. Hopefully we'll see some change in that, restoring to prior amounts. A couple other tax planning options. If you're a business that has inventory and you have what is known as subnormal goods, things that aren't saleable at their prices and are at the normal selling prices that are unusable or obsolete, you can take a deduction for them if you write them off based on some limitations. One thing I want to point out is if you're on LIFO, you cannot take that deduction, and we will talk about LIFO here shortly. I mentioned earlier, I have 4 or 5 things that I like to talk about to manufacturers. This is another one, cost segregation. To build a building, and I make it as simple and quick as possible. If you're building a building, purchasing a building, adding onto a building, talk to us. A cost segregation study essentially allows companies to carve out pieces of that cost and get it into get quicker depreciation on it than the typical 39-year life of a building. So it really is heavy manufacturing, light manufacturing, really see big results. And if you can drop something from 39 years into 5 or 7 or 15-year property that we may be able to write off all in the current year, it definitely enhances your cash flow. So that is one of the items that we like to talk to our clients about all the time. Now, Nick mentioned earlier, IC disc. If you're selling overseas, I don't say overseas. If you're selling to foreign countries, Canada and Mexico included, and I typically use a rule of thumb of about $800,000 or more. If you're seeing foreign sales of about $800,000 or more, let's talk about an IC disc. What an IC disc does is it allows, through journal entries, allows a company to convert ordinary income into capital gain income by paying a dividend to its shareholders. And the operating company would pay a commission to the IC disc, take a deduction at ordinary tax rates. The IC disc pays a dividend to the shareholders at, which would be tax to capital gains rates. So it's a really simple way to get an additional tax benefit and a reduction of the tax rate. And obviously, the higher your foreign sales go, the greater the benefit. And there are different ways to calculate what that benefit may be, but it's something that has been a very powerful tool. Running out of time here. Captive insurance companies are something that we saw in the past with what's called 831B, that the IRS really didn't like, even though it was statutory. But there's also something, 831A, captive insurance companies, that we see a lot of that are, not just for tax planning. I mean, certainly there are tax reasons to do it, but there are also insurance reasons to do it. And these are 831As are insurance companies. They are governed like insurance companies, and they are a way to protect yourself, protect the company, and maybe reduce insurance costs at the same time. Deferred compensation, one of the things that we've looked at over the number of years is cash balance plans as a way to really get the owners of the businesses a bigger deferral, a bigger, much larger deduction. I also want to mention LIFO. This is probably my number one favorite thing that I like to recommend, and maybe we'll just end it with this. But LIFO is LIFO is something that used to be very hard to calculate. It has been made, the IRS has made it much easier. You can use indexes. The index for inflation at the end of September 2023 was 3.7%. I don't know offhand what it was this year. But when you have inflation and increases in inventory costs, LIFO allows you to increase your cost of sales, and really it gives you a quicker deduction on those inventory costs. So it really moves the inventory values from the balance sheet to the income statement. In periods of rising costs, going back to my college textbook, LIFO is very powerful. And we have seen great inflation these last few years. And we have seen huge numbers returned. And again, this is a deferral. But I have a client that elected LIFO, believe it or not, back in the 1950s, and has been deferring income for 70 years now. So we see that a lot. And even if you get a deferral for a couple of years, it's like getting an interest-free loan from the government. And who wouldn't take an interest-free loan from the government? So LIFO is something that we are big on and will continue to be. So if you're not on it, you want to talk about it, let us know. Flipping through here, Nick talked about the state. We are at 11 o'clock. Ohio's CAT tax change 2024 increased the minimum to $3 million. It's going to be 2025. It's going to be $6 million. So companies were were previously subject to the CAT tax, the minimum CAT tax. The minimum tax has been eliminated. They may not be subject to CAT tax going forward. Pass-through entity tax is something that Ohio put in 2022, and we've seen great benefits for clients there. And as Nick mentioned, I think 29 other states have it. And then I'll just skip through the international that Nick talked about. And the last question, do you need CPE credit? Check yes or no. It's 11:01. We are up against it, so I want to thank everybody. If you have any questions, certainly feel free to contact Nick, contact me, contact your HBK, who you work with at HBK, and we can work with them. But I thank you. Hope everybody's has a great day, and thank you for attending, and look forward to seeing you again at a future webinar. Bye now.
Thank you.